Dear students, today's topic is the extension of previous discussion on mutual funds for BA students of Money and Capital Market. We will talk about the concept of pension fund. Discussion is important in the context when Government of Pakistan introduced pension reforms from 1st July 2024 for civil servants of federal government, and one of the provinces has already amended Civil Servant Act 1973 with respect to pension fund system, named as KPK Civil Servant Amended Act 2022 pension system. To understand the concept, we classify employers into two categories, one government sector and other is the private sector. For government, Civil Servant Act 1973 include provisions for pension. Traditionally, before pension reforms 2022 by KPK government and 2024 by the federal government, pension system followed defined benefit plan, where pension benefits are defined and calculated based on length of service, salary and retirement age. A defined benefit is paid to employee on retirement irrespective of the amount earned on investment of pension fund. If there is a shortfall, employer will assume the risk and employee will get defined pension benefits. Technically, it is known as unfunded pension scheme, as it is not managed by separate entity of pension fund, rather the employer manage in-house and responsibility for payment of pension benefit to employee rests with the employer. Now let us look at private sector. For former private sector, there are two prevailing modes for provision of retirement benefits. One is employee old age benefit scheme under EOBI Act 1976, and second is the pension fund under VPS Rule 2005. Now, what is this pension fund system under VPS Rule 2005? Here, pension fund is an entity established to provide retirement benefit for employees. Pension fund is managed by financial institution, which is a separate entity from employer. It is not managed in-house pension fund by employer. It is funded through contributions made by employer and employee. This is the new contributory pension fund system which the federal government and KPK government has followed for civil servants and government servants. This is already in place for corporate sector since 2005 on voluntary basis. Let us go into more detail. Securities and Exchange Commission of Pakistan, with the approval of federal government, promulgated voluntary pension system rules 2005. It is based on defined contribution plan. In case of Pakistan, 10% of basic pay as pension contribution by employee and 20% of the basic pay by government on behalf of the employee, to be contributed to pension fund on monthly basis for every regular employee. Pension benefit depends on contribution and investment performance of fund. Pension benefit depends on investment performance. It is not defined benefit. Rather, investment risk will be borne by employee. Let us see how the affairs of pension fund will run. Life insurance company or an asset management company can operate as pension fund management company. Pension fund shall be in the form of a unit trust scheme. By unit trust, we mean investor will buy a proportion of the total fund and is governed by trust law. And such fund must be made up of an equity sub-fund, debt sub-fund, or money market sub-fund, or a balanced fund, etc. Now the question is that how an employee will get benefit on retirement. At the date of retirement of employee, all units of sub-fund to his credit shall be redeemed, means converted into cash at the net asset value notified at the close of the day of retirement, and the amount due shall be transferred to his individual pension account. The retired employee shall have the following two options. One, to withdraw up to 50% of the amount from his individual pension account as cash, which is permissible under the income tax ordinance. And number two is to use the remaining 50% amount to purchase an annuity from a life insurance company, or to enter into an agreement with the pension fund manager to withdraw from the remaining amount monthly installments for up to 15 years following the date of retirement according to income payment plan. So by annuity here we mean series of equal amounts, like we draw pension in a normal case. Withdrawal of funds before retirement. If a case arises that an individual employee intends to withdraw the fund before retirement, so a participant at any time before retirement shall be entitled to redeem the total or part of the units of subfund to his credit to the individual pension account. Now let us discuss benefits on pension before retirement. In case of death of a participant before retirement age, all units at his credit shall be redeemed at the net asset value, and the amount shall be transferred to his pension account. The amount in pension account of the deceased shall be divided according to the succession certificate in accordance with law. Nominated survivors shall then have the following options. 1. Withdraw his cash share or purchase an annuity from life insurance company. All this arrangement shall be governed by pension fund manager with the trustee. For every fund, the pension fund manager shall appoint a trustee with the approval of the Securities and Exchange Commission of Pakistan, where a trustee shall be a scheduled bank licensed under Banking Companies Ordinance 1962, which has a minimum A rating, and are a subsidiary of the scheduled bank, are a foreign bank operating in Pakistan, are a subsidiary of the foreign bank, are foreign bank operating as trustee, are a central depository company, are a subsidiary of the central depository company, or any other company approved by SECP. And now let us have an idea about EOBI. An Employee Old Age Benefit Institution Act 1976 deals with every business having 10 or more employees, and it is mandatory to be registered with EOBI. This is the second option for the private sector. Contribution shall be payable every month by the employer to EOBI in respect of every person at the rate of 6% of minimum wage as notified by the federal government, which nowadays in Pakistan is 37,000 per month, 5% to be contributed by employer and 1% to be deducted from the employee salary. Pension is calculated on 12 months average wage and the number of years of insurable service. There is a fixed range pension benefit, minimum 10,000 and maximum 21,000. So it's a hybrid plan as it contains characteristics of defined contribution plan and defined benefit plan. It is funded pension scheme, and it is administered by independent board of trustee. I hope the concept of pension fund will be clear to students. So if you want more details, so you can read the EOBI Act, or you can read the Pension Fund Act 2005, so you will get more details. Thanks very much.